All right, let's dive deep into Bitcoin investment. We're going to unpack how you can get started and what you need to know.
Yeah, it's really exciting to see how Bitcoin has opened up so many different ways to invest.
It really has. So for this deep dive, we'll be looking at a couple of different methods from this article here.
Right, we'll be focusing on two main approaches. The first is CFDs, which are offered through brokers.
Kind of the more traditional finance way to get into Bitcoin.
Exactly, and then we'll be looking at cryptocurrency exchanges. That's where you can buy and own Bitcoin directly.
Awesome. Okay, so first up, CFDs.
CFD stands for Contract for Difference. And it's essentially a contract that mirrors the price of Bitcoin. So you don't actually own the Bitcoin itself.
So you're making a bet on the price.
Exactly. You're betting on whether the price will go up or down.
Got it.
One of the big advantages of CFDs is liquidity. You can easily get in and out of positions.
Yeah, that sense, yeah.
Plus, CFD platforms usually have more advanced trading tools.
Okay. So for the more experienced investors.
Yeah.
So what about the more, interesting parts of CFDs like leverage?
Right, leverage. That's where you can amplify your gains, but also your losses.
So if Bitcoin goes up, you make more money, but if it goes down, you lose more.
Precisely. So let's say you invest $1,000 in Bitcoin and use a leverage of 5x. If Bitcoin goes up 10%, you make a $500 profit.
Whoa, instead of $100.
Yeah. But on the flip side, if Bitcoin drops 10%, you lose $500.
Oof. So leverage is powerful, but you really got to know what you're doing.
Exactly. It's important to understand how leverage works before using it.
Got it. Okay, so that's CFDs, kind of the more familiar way to invest with brokers and stuff.
Right.
Now, what about cryptocurrency exchanges? These are more like, you actually own the Bitcoin, right?
Yeah, exactly. With the cryptocurrency exchange, you're buying and owning the Bitcoin yourself.
So it's like, going from just window shopping to actually buying something.
Yeah, that's a good analogy. You have direct control over your Bitcoin.
So it's like holding the keys to your own digital vault.
Exactly. Plus, you usually have access to a much wider variety of cryptocurrencies.
Oh, that's cool. So are there any downsides to exchanges?
Well, the platforms can sometimes be a bit more basic compared to brokers.
Oh, okay.
And the fees can sometimes be higher.
So how do those fees work?
Exchanges typically charge a percentage-based fee on each transaction. So if you buy or sell $1,000 worth of Bitcoin, you might pay a fee of, say, 1%.
I see.
Whereas with CFDs, brokers usually make their money through the spread.
So it's like the difference between the buying price and the selling price, right?
Exactly.
So yeah, I guess choosing the right platform depends on, how you trade and all that.
Right. It really depends on your individual needs and trading style.
Okay, so we've talked about the two ways to invest, CFDs and exchanges. But let's see what this looks like in the real world.
Yeah, let's get into some practical examples.
Perfect, let's do it. Okay, so let's say we've picked our platform. Now we want to, actually buy some Bitcoin. What about timing? Is there a good or a bad time to buy?
Well, the Bitcoin market is open 24/7, so you can technically trade at any time.
So I could buy Bitcoin at 3 a.m.
You could, but certain periods see more trading activity. Usually, U.S. trading hours are the most active.
That makes sense. So for those of us not in the U.S., it can get a little tricky, right? What if I go to sleep and the price changes drastically?
Right, those overlapping market hours can be a challenge. Many short-term traders choose to close their positions before they sleep to avoid any surprises overnight.
Okay, so close positions before bed. Got it. But what if I'm not a short-term trader? What if I want to, hold Bitcoin for the long term? Do I need to be watching it all the time?
Long-term investment is a different game. You don't need to be glued to the charts 24/7, but it's still important to stay informed about major events and trends. Remember that crazy Bitcoin surge and then the sudden dip a while back? That's a perfect example of why even long-term investors need to stay vigilant.
Wow, yeah, good point. So basically, stay informed, but don't stress over every little price change. What about seasonality? Does Bitcoin have any patterns throughout the year, like we see with some traditional markets?
That's an interesting question, but it doesn't seem so. Unlike some assets that are influenced by seasons or holidays, Bitcoin really marches to its own beat.
Unpredictable as always, huh? So even if we use technical analysis to spot trends, got to be prepared for anything.
Exactly. Technical analysis can help, but it's not a crystal ball. Bitcoin is notoriously volatile. You got to be flexible and ready to adapt.
Speaking of things that make people nervous, what about scams? Seems like every time Bitcoin comes up, the word scam isn't far behind. How do we know what's real and what's not?
It's crucial to separate Bitcoin itself from the scams that unfortunately surround it. As a decentralized digital currency, Bitcoin itself is not a scam. In fact, even big institutions are starting to invest in it.
So it's not about Bitcoin being a scam, but rather watching out for, like, bad actors trying to take advantage.
Exactly. One of the biggest red flags is if someone guarantees huge returns with no risk. Like if they say you'll double your money overnight, probably too good to be true. Always be skeptical of get-rich-quick schemes.
That's good advice. What about those flashy websites with celebrity endorsements? Those always scream scam to me.
Well, not always, but do your research. Check if the platform is registered and regulated. Do they have a real address? Contact information. Transparency is key in the crypto world.
So basically, don't just jump in blindly. Do your homework.
Exactly.
Okay, so scans debunked, hopefully. Now, the big question. How much money should I actually invest in Bitcoin? Is there like a magic number?
Unfortunately, there's no one-size-fits-all answer. It really depends on your personal situation, your financial goals, your risk tolerance. The good news is that exchanges and brokers usually have pretty low minimum investments.
That's good to know. Makes it more accessible, right? But are there any hidden costs or fees that we should be aware of? Like things that could eat into our profits, especially for starting small?
You're right. There are fees to consider. Exchanges often have fixed fees for each transaction. So if you're only investing a small amount, those fees could take a bigger chunk of your profits.
Okay, so is there a minimum investment you'd recommend to make those fees less impactful?
It depends on the platform, but starting with at least 100 euros can generally help. But remember, that's just a guideline. The optimal amount will depend on your specific circumstances.
Got it. So fees and minimums, important things to keep in mind. But let's talk about, I guess, actually making those trades. Like, what are order types and how can they help us manage risk?
Order types are super important, especially because, as we've said, Bitcoin can be very volatile.
Okay, so let's break it down. What are market orders?
Market orders are pretty straightforward. You buy or sell at the current market price. It's the quickest way to enter or exit a position.
Sounds simple enough, but what's the catch?
The catch is the price can change quickly. So by the time your order is filled, you might end up buying or selling at a different price than you expected.
So market orders are good when speed is key, but you have to be okay with that risk.
Right. Now let's talk about limit orders. These give you more control over the price at which your order is executed.
Oh, okay. So like I can set a specific price I want to buy or sell at. That sounds helpful, especially in a volatile market.
Exactly. Let's say you're bullish on Bitcoin. You think the price will go up, but you don't want to buy right now. You could set a limit buy order at a price slightly below the current market price. If the price dips to that level, your order automatically fills.
Ah, okay. So it's like setting a trap to catch lower price. Smart.
Yeah.
And how about limit orders for selling?
Same concept, just in reverse. Let's say you own some Bitcoin and you want to take profits if it hits a certain price. You could set a limit sell order at that target price. And boom, if the price goes up to that level, your order automatically executes and you lock in those profits.
Okay, limit orders, got it.
Yeah.
So buying low, selling high, all that good stuff.
Mm-hmm.
But what about if we want to limit our losses? That's where stop loss orders come in, right?
Exactly. Stop loss orders are like your safety net. They automatically sell your Bitcoin if the price falls below a certain level.
So it's like setting a floor, right?
Yeah.
If the price crashes through that floor, my stop loss kicks in and protects me from further losses.
Exactly. Super important tool, especially in a volatile market like this.
But how do you know where to set that stop loss level? Is there a rule of thumb?
There isn't a magic number. It depends on your personal risk tolerance and the specific trade. You have to balance giving your trade room to breathe with protecting yourself from big losses.
So basically, a tight stop loss might get triggered too easily, while a wide stop loss might not offer enough protection.
Right, it takes practice and you have to really understand the market dynamics. And hey, that's where those demo accounts can be really useful. You can test out different stop loss strategies without risking real money.
Great tip. Okay, so we've got our orders sorted, but now let's talk about, I don't know, the mental side of trading. It can be pretty intense, right? I mean, Bitcoin is famous for its wild price swings.
You're absolutely right. It's like an emotional roller coaster sometimes, and it's so easy to get caught up in the hype.
So how do we keep a cool head when the market is going crazy? What are some psychological pitfalls to avoid?
One of the biggest ones is FOMO, fear of missing out. When everyone else seems to be making money, it's tempting to just jump in without thinking.
Yeah, it's that feeling of I'm missing the boat.
Yeah.
So how do we resist that urge?
Having a clear trading plan is key. Decide on your entry and exit points in advance and try to stick to your strategy, even when things get wild. Don't let your emotions take over.
So like having a roadmap for your trades instead of just reacting to every little price change.
Exactly. Another common trap is confirmation bias. We tend to look for information that confirms what we already believe, even if it means ignoring signs that might contradict our views.
So, for example, if we're already bullish on Bitcoin, we might only focus on the positive news and ignore any warnings.
Yeah, exactly. You have to
Yeah.
be objective and look at all sides, even if it challenges your assumptions.
Right, stay humble. Okay, so FOMO and confirmation bias, two big things to watch out for. What about like greed and fear? Those seem like powerful emotions that could easily mess up our trading decisions.
Absolutely. Greed might make you hold on to winning positions for too long, hoping for even bigger gains, even when it's time to take profits.
And then fear might make you sell too early, missing out on potential gains because you're worried about losing money.
Exactly. Managing those emotions is so crucial. A good way to do that is to set clear profit targets and stop-loss levels beforehand. That takes the emotion out of it. You're not making those decisions in the heat of the moment.
All right, so you're sticking to the plan. Good strategy. But what about those times when, you do make a loss? It's going to happen, right?
It definitely will happen. Losses are part of the game. Don't let a few losses shake your confidence. Learn from them and adapt your strategy.
Okay, losses are learning opportunities.
Got it. So we've talked about emotions, but what about analysis? Like, are there different ways to analyze the Bitcoin market to make better decisions?
There are two main types of analysis: technical analysis and fundamental analysis.
Okay, let's start with technical analysis. What's that all about?
Technical analysis involves looking at historical price charts and trying to spot patterns and trends that might give us clues about where the price could go in the future.
So it's like looking for clues in the past to predict the future.
Exactly. Technical analysts use all sorts of tools and indicators. They look at things like support and resistance levels, trend lines, and all sorts of patterns that could suggest buying or selling opportunities.
Sounds pretty complex. It takes practice for sure. There are a lot of different schools of thought and indicators to learn.
What are some examples of those indicators that Bitcoin traders use?
Some popular ones are moving averages, which smooth out the price data to identify trends, the relative strength index, RSI, which measures price strength and can tell you if something is overbought or oversold, and the MAD, which can spot changes in the direction of a trend.
Wow, so many acronyms. Okay, so technical analysis is all about charts and patterns, right?
Right. Now, fundamental analysis is different. It goes beyond just looking at price charts. It's about understanding the factors that drive Bitcoin's value.
Okay, so it's more about the big picture.
Yeah, it's about looking at things like adoption rates, technology developments, regulations, even the overall economy, to get a sense of Bitcoin's intrinsic value.
So technical analysis focuses on the what of price movements, and fundamental analysis is trying to understand the why.
Exactly. They're looking for those fundamental drivers that could support or undermine Bitcoin in the long run.
What are some examples of those fundamental factors?
Well, one big one is institutional adoption. When those big financial players like banks and hedge funds start investing, it adds a lot of legitimacy to Bitcoin.
Makes sense? It's like
Yeah.
they're saying, hey, this is a serious investment now.
Right. And another key factor is regulation. Uncertainty around government regulations can cause a lot of volatility in the market.
So clear and supportive regulations could be a good thing for Bitcoin.
They could, because it fosters more confidence and encourages wider adoption. But on the other hand, negative regulations could have the opposite effect.
Right. Governments could crack down on Bitcoin, and that could hurt its price. So it's a bit of a waiting game to see how regulations play out.
It is. And then there's technological innovation. Scalability is a big one. How
Yeah.
well Bitcoin can handle a lot of transactions.
Right, we've heard about those network issues that can lead to higher fees and slower transactions.
Exactly. But developers are constantly working on solutions. The Lightning Network, for example, aims to make transactions faster and cheaper.
So it's like building a faster highway for Bitcoin transactions.
That's a great way to put it. And there are other areas of innovation like privacy, security, and smart contracts.
Smart contracts are fascinating, right? The idea that you can have these self-executing agreements on the blockchain opens up so many possibilities.
Totally. We're just scratching the surface of what's possible with Bitcoin and blockchain technology. The future is exciting, but also full of challenges.
Right, it's important to remember that Bitcoin is still a young technology. There are risks involved.
Absolutely. Like with any investment, do your research, understand the technology, and know the risks. And never invest more than you can afford to lose.
That's a crucial point. So it sounds like both technical and fundamental analysis are important for making informed decisions.
They are. A lot of successful traders actually use a combination of both.
So it's not about picking one over the other, it's about using them together to get a more complete picture of the market.
Exactly.
Okay, great. And of course, always manage your risk. Okay, so we've learned about CFDs, exchanges, order types, risk management, even the psychology of trading. Phew, that's a lot.
It is, but it's all super important if you want to navigate the Bitcoin market successfully.
Definitely. But before we wrap things up, let's talk about the future. Like, where does Bitcoin go from here? What's its role in the, grand scheme of things?
It's the million-dollar question. It's amazing to see how far Bitcoin has come. From this niche idea to, well, a mainstream asset. It's attracting everyone these days, from everyday investors to big financial institutions. Even governments are taking notice.
Yeah, it's been quite a ride. But what are some of the things that could shape Bitcoin's future?
One of the big trends we talked about earlier is institutional adoption. As more of these established players get involved, it adds a level of, legitimacy to the market.
Right, it's like a seal of approval from the traditional financial world.
Exactly, and that could lead to more liquidity, more sophisticated investment products, and who knows, maybe even wider mainstream acceptance.
So we might see Bitcoin becoming more and more integrated into our everyday financial systems.
It's definitely a possibility. Another big factor is regulation. How governments decide to regulate this new technology will have a huge impact.
It's a tough one, right? It's this new disruptive technology, and governments are still figuring out how to approach it.
Yeah, it's a balancing act. Clear and supportive regulations could really boost innovation and adoption, but too much restriction could stifle its growth.
So we'll have to wait and see how that all plays out. What about the technology itself? Any exciting developments on the horizon?
Absolutely. Scalability has been a challenge. How many transactions Bitcoin can handle.
Right, those network congestion issues, high fees, slow transaction times, that kind of stuff.
Exactly. But developers are always working on solutions. The Lightning Network, for example, aims to make those transactions much faster and cheaper.
So it's like building a faster, more efficient network on top of the existing one.
Exactly. It's about handling that growing demand. And beyond that, we're seeing innovation in areas like privacy, security, and smart contracts.
Oh yeah, those smart contracts, such a cool concept. Self-executing agreements on the blockchain, it's like something out of a sci-fi movie.
I know, right? And we're just getting started. The possibilities are endless. But of course, we have to acknowledge the challenges and risks too.
Absolutely. Though Bitcoin's still a young asset, and it's super volatile. Got to be realistic about that.
Exactly. So as we wrap up this deep dive, I think the key takeaway is knowledge is power. The more you understand about Bitcoin, the technology, the market, the risks, the better decisions you'll make.
Couldn't agree more. Any final words of wisdom, especially for navigating the emotional side of Bitcoin trading?
It's crucial to stay disciplined and rational. Don't let the hype, the fear, or the greed control your decisions. Have a plan, manage your risk, and remember, patience often pays off in the long run.
Love it. And never stop learning, right? This world is always changing.
Couldn't have said it better myself. It's been a pleasure chatting with you today.
Likewise. And a huge thank you to all our listeners for joining us on this Bitcoin deep dive. We hope you learned a ton. Keep exploring, keep learning, and until next time, happy investing.